Recession talk is back.
Perhaps even a recession.
Guarantee of a recession.
We're going into a recession.
Depending on which economist you ask, we're either on the edge of one, already in one, or about to dodge it like we've dodged the last several. Markets have heard this warning before. Economists have predicted a US recession every single year for the past 8 years. The US grew through all of them. One or two had genuine close calls, but for the most part, the economy kept going despite the consensus. So whenever this conversation resurfaces, it's worth asking, what's different this time, and whether the concern has more behind it. What's changed this time is more concrete. When US-Israeli strikes on Iran led to the closure of the Strait of Hormuz, oil prices jumped from the low $60 to nearly $100 a barrel almost overnight. Now, an oil shock has preceded 8 of the last 9 US recessions. That's not a guarantee, but it's a signal serious economists do not ignore. Moody's Analytics has its recession probability model at 48.6%, Wilmington Trust is at 45%, EY Parthenon at 40%, and Goldman Sachs at 30%. In a normal environment, the baseline probability of a US recession in any given 12-month window sits around 20%. Every one of those estimates is well above that. Now, none of those forecasters are predicting a recession outright. Their baseline still involves some diplomatic resolution, oil flowing again through the strait, and the US economy getting through it. But as each week passes with the strait closed, those baselines look less and less probable. A few things in the data stand out. Where growth is concerned, the US economy nearly stalled in Q4 2025, growing at just 0.5%. Then, in Q1 2026, we saw it come in at 2% on paper, and this growth was supported by a bounce in government spending after the federal shutdown, stronger investment, and a surge in imports as businesses rushed to build stocks ahead of possible price hikes and supply shortages, a pattern April PMI surveys also picked up. Look past those temporary supports and the economy looks softer. Meanwhile, the Fed's preferred inflation measure jumped to 4.5% in Q1, well above target and moving in the wrong direction. Now, moving on to jobs, hiring has become increasingly uneven. February brought an unexpected payroll decline, and much of the recent strength has been concentrated in defensive areas like healthcare rather than spread across the economy broadly. The unemployment rate is holding at 4.4%. But largely because companies aren't laying people off rather than because they're actively hiring. And lastly, consumer confidence. The University of Michigan Sentiment Index fell to 49.8 in April, the lowest reading on record going back to 1952, lower than at the start of the Great Recession, lower than during the pandemic. Year-ahead inflation expectations surged alongside it, and when households are that pessimistic, it tends to show up in spending data a few months later. Why? Well, that's because consumer spending drives roughly 2/3 of US GDP. And the Fed is caught in the middle of all this. Rates are currently held at 3.5% to 3.75%. Cutting risks adding fuel to an already hot inflation problem, and holding rates risks letting a weakening labor market get worse. Neither option is clean, and markets know it. So, put together, that leaves the market looking at elevated risk, slower growth, rising prices, and a central bank with limited room to move. Markets don't wait for the official verdict. When recession risk rises this much, investors start repositioning before the data confirms anything. They pull back from risk assets, rethink allocations, and liquidity starts to tighten across markets. And that is why crypto holders need to pay attention now, even before any recession is officially called. So for crypto holders, the answer changes with the time frame. There's something a bit ironic about where Bitcoin sits in all of this. It was created in the shadow of the 2008 financial crisis. So in theory, this should be exactly the kind of moment where it shines. And yet, in the short term, it hasn't been acting like a crisis asset at all. When the Iran conflict escalated and recession fears intensified, Bitcoin fell from its October 2025 all-time high of around 126K to roughly 62K in February, a drop of just over 50%. And it also moved together with tech stocks. Subsequently, when gold hit record highs above $5,400 an ounce, Bitcoin sold off. That pattern has shown up in several major stress events, including 2020 and 2022. When liquidity tightens and fear spikes, Bitcoin tends to fall with risk assets rather than hold its value the way traditional hedges do. For people already in the market, stablecoins have increasingly become the practical shelter during periods like this. It's a way to stay inside the ecosystem without being fully exposed to the volatility. And that is where a meaningful share of crypto capital has been sitting through the most uncertain stretches of 2026. But things are different in the long term. Modern recessions have usually pushed policymakers toward some mix of rate cuts, stimulus, or liquidity support. And historically, when that has happened, Bitcoin has often responded strongly. When central banks expand the money supply and cut rates, capital tends to find its way toward scarce assets, and Bitcoin's fixed supply has made it part of that story more than once. BlackRock's head of digital assets, Robbie Mitchnick, has previously argued that
a recession would be a big catalyst for Bitcoin.
Not despite the downturn, but because of the monetary response that follows it. The clearest precedent was 2020. Bitcoin fell 50% in March of that year and then rose over 1,000% in the 12 months that followed as stimulus followed through the system. Now, nobody can time a recession perfectly, and it's not clear this one is even coming, but getting a rough sense of where you are in that cycle is probably better than watching the daily price. Tightening and fear tend to come first, then rate cuts and liquidity, and then the conditions that have historically driven the next move for crypto markets. So we are curious, how are you thinking about your crypto portfolio right now? Are you sitting tight? Are you moving into stable coins? Or you're just watching from the sidelines? Well, let us know in the comments. And of course, like and subscribe if you haven't already. And I'll see you in the next one. Bye.